Okie doke. Okay, guys, so chapter 3, I'm not what? It was in there. I don't know what I did wrong. Oh, here I am. Okay, so chapter 3, we are going to start, and then from there, we'll go through as much homework as you want. And, whoops. I'm going to pause a minute. Okay, so I am going to begin here. Get it going here. Okay, so last week we began talking about job order costing. Do you guys like all the lights on? Do you want me to turn some off? Are you okay? Okay. So we began last week discussing job order costing. And this happens when there are unique products that are being produced, or even services, or if there's many different types of products happening in the same day. So this is carrying on our discussion of job order costing. But now what we're going to do is we're going to look and compare job order costing to what is now the term absorption costing. So we're going to learn some new vocabulary today. Job order costing, we know about from last week, a costing system used in situations where many different products, jobs, or services are produced each period. Absorption costing is a costing method that includes all the manufacturing costs, direct materials, direct labor, and not bother, but both variable and fixed manufacturing overhead in the cost of a product. So it just takes into account everything. We know from last week, this allocation base is really key to drive the cost. So a lot of times that manufacturing overhead category can just be loaded with so many various costs. And utilizing the allocation base, be it by direct labor hours or machine hours, allows us to accurately, there. It allows us to accurately take those that manufacturing overhead and apply it to specific jobs. Remember, with manufacturing overhead, the manufacturing overhead is just a big pot of so many different kinds of expenses. So utilizing that manufacturing overhead, we need to find a way to apply it to the various jobs. Okay, let me see what I'm doing wrong here. So here, I got way ahead of myself. Okay, let me just go back and start. So the allocation base is what we use for allocating that manufacturing overhead to the various different jobs. Now, last week, we also talked about the predetermined overhead rate, okay? This is the rate used to charge manufacturing overhead costs to jobs that gets established in advance for each year. So we don't know all the actual manufacturing overhead that's going to be put in this huge bucket. But in order to make sure we're pricing the jobs correctly, we've got to come up with some fashion of the manufacturing overhead we think we're going to have throughout the year so we can assign those jobs. Predetermined overhead rates, remember, is always an estimate. We estimate the overhead rate and we estimate the total manufacturing overhead costs. And we estimate the allocation base to come up with that predetermined overhead rate. It's all an estimate. That's the best we have because none of the costs have come in yet. Okay. Now, another overhead application. The process of assigning overhead costs to specific jobs using the same formula. Overhead applied to a particular job is going to be at that predetermined overhead times the amount of allocation based incurred by that job. So that's going to be the actual allocation, either actual machine hours or actual direct labor hours. Then we have normal costing, a costing system where overhead costs are applied to a job. And we do that by multiplying the predetermined overhead rate by the actual amount of the allocation base that was incurred by the job. We saw last week a job cost sheet. It's just the form that allocates all the costs specifically to that job. We need to know those costs in order to price it because we want to make sure we take care of those pricing plus make a profit. So first of all, we are going to see how the flow of costs happen and the journal entries we're going to use for these flow of costs. In other words, when we requisition materials, the flow to go into the particular order, and then ultimately go into finished goods, ultimately cost of goods sold. So we're going to look at that. We know inventory in managerial or in financial accounting. We talked a little bit about manufacturing costs, but for the most part, inventory was inventory. Here, we have so many different accounts under inventory. The big category, this asset of inventory, will have a component of raw materials. It'll have a component of work in process, which is while goods are being manufactured or products are being manufactured, we put them into the work in process. They will stay there in work in process until they are completely finished. It's at that time we transfer those to finished goods. They will stay in the balance sheet as an asset called finished goods until they're sold. Once they're sold, they're removed from the asset finished goods and they go right into the income statement under cost of goods sold or cost of goods manufactured. Cost of goods sold would be in the income statement. The cost of goods manufactured are those goods that are ready to be sold. So we're adding one more link here to the process. So this is really helpful. You see all the costs that go into making a product are going to stay in inventory until they are sold. However, we are going to have some selling costs and we are going to have some admin costs that really don't go into the product. They're period expenses. They're going to flow right to the balance sheet as an expense, not the balance sheet, the income statement as an expense in the period in which they were incurred. Because we're dealing with manufacturing companies, we're just trying to understand that so many of these costs are going to stay as an asset until we actually sell the goods. Okay, so even though we have salaries, if it's in the factory, those salaries are going to stay as an asset because they're part of making that product until we sell the goods. So here we go. To illustrate the cost flows within a job order costing system, we're going to look at Ruger's Corporation's transactions for the month of April. Ruger's, a producer of gold and silver commemorative medallions, and it only worked on 2 jobs in April. The first job, a special minting of 1,000 gold medallions commemorating the invention of motion pictures. It began this job in March and it completed it in April. As of March 31st, Job A, this particular job, has been assigned $30,000 in manufacturing costs, which correspond with Ruger's work in process balance on April 1st of $30,000. So it really only had one job at the end of March that's sitting in work in process. It's not done yet. But the job B started in April. This was an order for 10,000 silver medallions commemorating the fall of the Berlin Wall. It started in April, but it wasn't completed in April, okay? So it's going to be sitting in work in process at the end of April. So here you see when raw materials, the silver, the gold, are requested from the raw materials storehouse, they are going to be credited. They're no longer in raw materials. So it gets credited from the inventory asset account, raw materials, and it goes straight into work in process. Any indirect raw materials that really aren't assigned to specific jobs will go into manufacturing overhead. The bummer in manufacturing companies is there is such a huge account called manufacturing overhead, and we've got to find a way to allot it to specific jobs. So that's the goal, is to try to find the best way possible. Who's utilizing all these resources that go into manufacturing overhead? But no, most of those direct materials that are specifically applied to a job go right into work in process. So purchase of raw materials in journal form. On April 1st, Ruger Corporation had 7,000 in raw materials on hand. But during the month, the company purchased an additional 60,000 of raw materials. So when the company goes and purchases those 60,000, they're going to debit the raw materials account and credit the payable. During April, materials requisition forms were prepared to authorize withdrawing 52,000 in raw materials from the storeroom for using it in doing this order. These raw materials included 50,000 of direct materials and 2,000 of indirect materials. So you see the 50 of direct materials goes right into work in process. The 2,000 that are indirect materials that really can't be assigned specifically to this job go into that overhead account called manufacturing overhead. And you see the credit is that inventory raw materials. Now we've got labor. Salary and wages payable. The direct labor specifically linked to this job goes into work in process. Any indirect labor goes right into manufacturing overhead. So in April, the employee time tickets, which give us those hourly summaries of the activities, included $60,000 recorded for direct labor and $15,000 recorded for indirect labor. So the journal entry would be work in process for $60,000. That directly links to the job. But that indirect labor of manufacturing overhead goes for $15,000 right into the overhead account. And again, we credit our salaries and wages payable. So right now, you see, we've got the salary and wages payable. Some go to direct, some go to indirect. The manufacturing overhead, we're lumping a lot into for indirect materials, wages are going into manufacturing overhead, along with other costs going in there. And our work in process right now just solely shows us our direct materials and our direct labor. Okay? Now, let's assume Ruger has utilities for the month of $21,000, rent on the factory equipment of $16,000, and $3,000 in other overhead costs. All of this $40,000 is going to get lumped into manufacturing overhead. Now, if we paid the bills, of course, we would have credited cash. In this scenario, we're just assuming we have not paid the bills yet. So we are crediting account, just so you know that. Okay? So we need to show regarding this particular job, we need to allocate some of that manufacturing overhead to what we're currently working on. So the way in which we take care of that, is by that allocation rate. So our actual hours, machine hours or labor hours, and then we apply, based on that predetermined overhead rate, how much is going to go just into this job. So as we know, the actual, what we come up with at the end of the period and what we're applying are never going to be perfect. We're doing the best we can to come up with an estimate, but usually it's going to be over applied or under applied. At the end of the period, we're going to make sure we balance correctly. In the meantime, all we can do is estimate this manufacturing overhead. So we're applying it. Once the true numbers come in, we'll then know, did we over apply manufacturing overhead, which means send more to the jobs than that we really had in actual cost, or under apply means we underestimated what our manufacturing overhead would be. Therefore, we've got more costs than what we thought. So again, for this job, we're going to take some out of manufacturing overhead, put it also into our work in process. So in this case, the predetermined overhead rate is $6 per machine hour. And then we've got, during April, 10,000 machine hours were worked on job A, 5,000 machine hours were worked on job B, 15,000 machine hours. So we've got at $6 an hour, we're debiting work in process for 90,000, we're crediting our manufacturing overhead. Okay? Remember, the predetermined overhead rate is based on pure estimates. The amount we apply is based on actual machine hours for that job times that predetermined overhead rate. It's the best we can do right now. So the non-manufacturing costs don't get assigned to individual jobs. So selling expenses and any administrative expenses are period costs. They're not linked to the jobs. Yes, we need those costs in order to sell, but they're not specifically job-related costs. Therefore, those go right into the income statement as an expense. See how we're flowing everything else through inventory, but not items that are non-manufacturing related. Salary expenses of employees that work at marketing, selling, or administrative capacity will never be put in production costs. Advertising expenses are also non-manufacturing costs. Okay, guys? Don't forget that. Those are period costs. So when Ruger's has $30,000 in selling and admin salary costs during April, then it goes right into salaries expense and credit are payable. When there's depreciation on office equipment, non-manufacturing costs, we just put it right into depreciation expense and credit our accumulated depreciation. And then, the advertising expenses, again, all of these would be non-manufacturing costs, are going to go right straight to the income statement, not to any product costs. This is not working, so I'm gonna plug this here. This is a whole new setup for me, so I'm getting used to this, guys. Sorry. Oh, no wonder it wasn't plugged in. It helps to have it plugged in. Okay. So basically, the point of this slide is just helping you understand that non-manufacturing, those expenses a company incurs that are outside of actually manufacturing the products, go right to the income statement. They don't flow through the inventory accounts. So now, let's say a job is completed. It's been in the process of working on it. Now that it's completed, we will then credit our work in process. We'll credit cost of goods manufactured for that job, take it out of work in process, and still put it into another inventory account, but this account's called finished goods. This is sitting in the warehouse waiting to be sold. Okay? Still inventory accounts. We've just got all these sub-accounts that are linked with inventory. Transferring completed jobs from work in process to finished goods shows here a debit to that inventory account, finished goods, a credit to the inventory account, work in process. Because job B was not completed by the end of the month, its assigned costs are going to stay in work in process. Remember, job A got completed in April, but job B didn't. So that will still be sitting in work in process at the end of the month. In May, it will be taken out of work in process and go into finished goods. If a balance sheet would have been prepared at the end of April, the cost accumulated so far on job B would be $72,000. So it would have currently been $72,000 because it wasn't completed yet. Now, once the goods are sold, that's when we'll take it out of finished goods and we debit then our cost of goods sold. So transferring finished goods to cost of goods sold. I know you guys will probably remember this from financial accounting, but there's two journal entries, one to show the sale and one to show the goods are done. The goods are no longer an asset. They're now expensed on the income statement. So here you see, we assume 750 of the 1,000 gold medallions in job A were shipped to customers at the end of the month for total sales revenue of $225,000. Because 1,000 units were produced and the total cost of the job from the job cost sheet was $158,000, the unit product cost is $158 per unit. Since we sold 750 of them, we're only going to take cost of goods sold of 158 times 750, meaning the other 250 are still sitting in finished goods, right? We made 1,000, but we're only selling 750. Oh, and you know, what we're selling them for is a different price than what it costs for us to make them. So two separate transactions, one showing the sale, but corresponding, one taking them out of our finished goods and putting them into the expense account called cost of goods sold. Any questions, guys? Is this clicking a little bit? So let's look at an example here. This example shows us that Polaris Company uses a job order costing system. In October, they purchased raw materials of $210,000 on account. Raw materials then transferred to production are $190,000. Now, how that's made up is based on $178,000 of direct raw materials going into the product cost and $12,000 of indirect materials are going straight to manufacturing overhead. Okay? Then we've got direct labor that's being accrued of $90,000, which means that's going straight into this particular job. And the indirect labor of $110, where's that going to go, guys, when we have indirect labor of $110? Excellent. Manufacturing overhead. You're exactly right. Then we're going to record depreciation on the factory equipment. That's going to go into manufacturing overhead. And then we've got other costs of $70,000. Manufacturing overhead costs going into manufacturing overhead. See, that bucket gets really big. The company applies manufacturing overhead costs to production using a predetermined rate of $8 per machine hour. So the total of 30,000 machine hours were actually used. So we will apply that manufacturing overhead to specific jobs. Jobs costing $520,000 according to their job cost sheets were completed during October and transferred to finished goods. And then jobs that had cost $480,000 to complete according to the job cost sheets were shipped to customers. So those were sold. These jobs were sold on account at 25% above cost. Okay? We are going to prepare journal entries to record these transactions, and then we're going to do some T accounts. So what I want you to do is let's take 5 minutes, guys, and look at these and try to do some journal entries to see if it's clicking with you. Okay? I'm not going to ask you. I just want you to attempt them on your own first. Okay? Okay, you guys doing okay? You want a little more time? Are you okay? Just tell me. Okay, so let's take a minute here. So guys, raw materials purchased on account. Pretty straightforward. We're going to debit our raw materials for 210,000, credit our accounts payable for 210,000. Got it? Raw materials used in production, the 178,000 will go right into work in process, but those indirect materials are going to go into manufacturing overhead, 12,000. And we credit the raw materials inventory account for 190. Make sense so far? Then accrued direct labor cost of 90,000 will go right into work in process. Our indirect labor cost of 110,000 goes into manufacturing overhead. We credit our salaries and wages payable. Then depreciation on factory equipment will go right into manufacturing overhead. Then other manufacturing overhead costs accrued during October, 70,000. Boy, it's a big pot, isn't it? Manufacturing overhead, 70,000. Credit accounts payable for 70,000. Now it says the company applies manufacturing overhead costs to production using a predetermined rate of $8 per machine hour. A total of 30,000 machine hours were used in October. So 30,000 times 8, we're going to debit our work in process. We credit our manufacturing overhead. Make sense so far? Jobs costing 520,000, according to their job cost sheets, were completed during October and transferred to finished goods. So 520 is now in the inventory account finished goods. We credit work in process for 520,000. Jobs that had cost 480,000 to complete according to their job cost sheets were shipped to customers during the month. These jobs were sold on account at 25% above cost. So we'll take the 480,000 times 1.25 or 125% to give us the selling price of 600,000. Okay? We know cost of goods sold is the expense account on the income statement. The cost of those goods are $480. So we have to have two separate journal entries. One to debit our cost of goods sold and then credit our finished goods, and the other to show accounts receivable for 600 and our sales of 600. Make sense so far, guys? Isn't it easy when you do it together? Kinda. And then it gets overwhelming. Well, that's where these lectures will be helpful. Just go back over them until it sinks in. Sometimes, guys, I just have to go back over things 3 and 4 times because I might pick up on certain things the first time around, and then the second time around, I grasp a little more. Make sense? It's all new. This will show you the T accounts. All the journal entries, the transactions that affected manufacturing overhead are shown here. So you see the various costs that went right into manufacturing overhead, we debited. I'm going to shut this door. But do you see what we transferred out? You see the amounts that we transferred out? We transferred out 2 jobs, 240,000. Do you see our manufacturing overhead has a credit balance? That means we assigned to jobs more than we actually really had. So that means we over applied the overhead. We used too much of it. In other words, we assigned to jobs more than what we really had in costs. Okay? We know that because we have a credit balance in manufacturing overhead. The work in process is going to, in this case, the jobs we had were all completed. So the work in process, there's nothing left in the, no, excuse me. We started with 42,000. We have not completed them all. There's 30,000 still sitting that haven't been completed, that are still in process at the end of the period. Does that make sense? Knowing, you will know if you under apply or over apply manufacturing overhead based on the balance. If it's a debit, we under applied it. If it's a credit, we over applied it. Let's look at another one. Is this helpful to go through these? Let's look at another one here, guys. Dillon Products manufactures various machined parts to customers' specifications. The company uses a job order costing system and applies overhead cost to jobs on the basis of machine hours. At the beginning of the year, the company used a cost formula to estimate that it would incur $4,800,000 in manufacturing overhead costs at another estimated activity level of 240,000 machine hours. The company spent the entire month of January working on a large order for 16,000 custom-made machine parts. Larger 16 custom-made machine parts. The company had no work in process at the beginning of January. Cost data relating to January follows. So you've got the raw materials purchased on account, then transferred into production. Some were direct, some were going into manufacturing overhead. The labor that's being incurred or accrued, depreciation, other manufacturing overhead, and then how it was applied. Okay? Let's see if that is it. So here, what we want to do is prepare those journal entries. And then we'll work on the last piece together. So this should be easier this time, guys, because we've already done it. So I'll give you 3 minutes here. It should flow smooth. So Nazra, Christopher, Anna, Ashley, Nathaniel.
Yep.
Nate, I'm sorry.
It's okay.
Scott and Yang. Yufin, am I saying? So there's 1, 2, 3, 4, 5. There's 7. So Scott and Yufin aren't here. I do that, guys, because at the end of the semester, if you're sitting with an 87 or 88 and you're coming to class because I have to be here, I remember that. So you do not get graded on attendance. Just so you know, you do not get it graded, but you're going to see an area in there where I'm going to show you we're here. Okay. I do that just so I look back at the end of the time. You're sitting at an 88. I can use I'll never harm a student, but I can use my discretion to up you. Make sense? Today the 25th or 25th? Okay. So here we've got raw materials and accounts payable, 325,000. The next work in process is for the direct. The indirect goes into manufacturing overhead of 58,000. So work in process is 232,000, manufacturing overhead of 58,000. It gets credited from raw materials of 290,000. Next, we debit our work in process for 60,000. We debit our manufacturing overhead for 120,000. We credit our wages and salaries payable for 180,000. Then related to our depreciation on the equipment, we debit that to manufacturing overhead of 75,000. We credit our accumulated depreciation of 75,000. Manufacturing overhead for odds and ends, 62,000. Credit our accounts payable, 62,000. Then we apply the manufacturing overhead to work in process, a debit of 300,000. We credit our manufacturing overhead for 300,000. How do we determine the predetermined overhead rate? Estimated manufacturing cost divided by estimated machine hours. Got it? Remember, the predetermined overhead rate is estimate divided by estimate. What we apply is the predetermined times actual. Here we show the T accounts. Did we over apply or under apply here? Looks like we under applied. Okay. The cost of the completed job is 592,000 as shown in the work in process. The journal would be debit to finished goods, credit to the work in process. If 10,000 of the custom-made parts are shipped to customers in February, how much of this job's cost will be included in cost of goods sold? So we had made 16,000 units. We can come up with our price per unit, but we actually sold 10,000 of those units. So 370,000 would go into cost of goods sold. Does that make sense, guys?
How do we get the cost of 592,000?
They just told us.
Okay.
That was just given to us.
Okay.
Okay. Now, we've been working on the journal entries. Now we're going to prepare two financial statements, cost of goods manufactured, and then the income statement. So this cost of goods manufactured and cost of goods sold contains our direct materials, our direct labor, and our manufacturing overhead. Here, we're going to look at when raw materials are being used in production. We have that's a manufacturing cost, the raw materials. The direct labor is also a manufacturing cost, as would be what we apply to our manufacturing overhead. Okay, those are all the three manufacturing overhead costs. So when this work in process account will always have a beginning balance and pretty much always have an ending balance. What's still being worked on at the end of the period. But during the period, we're going to add these manufacturing costs to the work in process as we're transferring them in. So total manufacturing costs are added to the beginning work in process to arrive at total work in process. The ending work in process inventory is deducted from the total work in process for the period to then arrive at the cost of goods that have actually been manufactured, are no longer sitting in work in process. Okay? The cost of goods manufactured is added to the beginning finished goods inventory to arrive at cost of goods available for sale. But the ending finished goods inventory gets deducted from that figure so we know what was sold. So it's a flow. It's a workflow, these financial statements. Beginning raw materials is $32,000. During the month, $276,000 of raw materials was purchased. A count at the end of the month revealed that $28,000 of raw materials is still present. What is the cost of direct materials used? $32 plus $276 minus our $28,000, right? See how that's pretty straightforward. Direct materials used in production totaled $280,000. Direct labor is $375,000, and manufacturing overhead of $180,000 was added to production. What were the total manufacturing costs incurred for the month? Just add them all together. Okay. Beginning work in process is 125. Manufacturing costs added to production is 835. There are 200,000 of partially finished goods remaining in work in process inventory at the end of the month. What's the cost of goods that were manufactured during the month? So we add the beginning plus what was brought in, subtract what's still in work in process. We'll show you what was actually manufactured. Beginning finished goods inventory is 130. Cost of goods manufactured is added in of 760. The ending finished goods inventory is 150. What was sold during the period? 740. Okay. So now we've got sales, direct labor costs, raw materials, selling expense, admin expense, manufacturing overhead applied to the work in process, and then the actual manufacturing overhead cost. So you guys can see if we applied 90 but actual's 80, we over applied it, didn't we? Okay. Then we've got our beginning and ending inventory amounts for our raw materials, our work in process, and our finished goods. Prepare a schedule of cost of goods manufactured. Assume all raw materials were direct materials. So they're not going into manufacturing, they're going right into work in process. So let's do that one first. So we're going to utilize all this information to figure it out. We'll start with what beginning work in process was, the 10,000. Okay, that's what we start with. Now we have to go back though to our raw materials. They gave us our beginning balance of raw materials, what we purchased during the period, and our ending raw materials. Remember that? Back here. Raw materials started at 7. We purchased 118 and we ended at 15. So we know the difference was transferred to work in process. Okay? So let's just start there. We started with 7. We added 118. So direct raw materials available, or total raw materials available, is 125. If the ending inventory is at 15, that means we transferred into work in process 110. Okay? We add our direct labor. We applied 90,000 to our work in process. So if we began with 10, we add our 270. We've got total manufacturing costs of 280. If our ending work in process balance was 5 here, see where we're getting it? If it's 5, that means we manufactured 275,000 during the period. Okay? Now, let's go back here and see our finished goods. Do you see we started with 20 and we ended with 35? See that? So what we're going to do here is we're going to start beginning finished goods inventory of 20. We brought in 275 because that's what was actually manufactured. So cost of goods available for sale is 295. We know our ending finished goods inventory was 35. So technically our cost of goods sold is 260. What we're doing here, it gave us the 90,000 we applied to manufacturing for manufacturing overhead, but it was really only 80. You see, so we overkilled, we overestimated. Here it's at this time. If we've overapplied it, we're going to subtract how much we've overapplied. If we've underapplied it, we're going to add it to really come up with what cost of goods sold should be. Okay, it's at this time we'll adjust it. We overapplied 10,000, that's why we're subtracting that difference. Okay? Do you see the flow, guys? When it gets overwhelming for you, just pause and say, no, I'm going to break it down. You know, instead of looking at the big picture, you break it down. Raw materials first. Figure out how much were transferred to work in process. Start with the beginning work in process. Show what's been added in manufacturing costs. Keep it, break it down per department or per inventory sub-account. The income statement, we've got our sales. They told us the cost of goods sold, or we calculated the cost of goods sold, which then gives us our gross margin with our non-manufacturing costs, which we know they're period expenses that go right to the income statement, which show our net income to be $71,000. How you guys doing? Do I say that too much? I'm always trying to read you. Now, we're going to, we already did this in that problem, but we're going to understand a little more about under applying or over applying the inventory, okay? The difference between the overhead cost applied to work in process and the actual overhead cost is going to be known as either over applied or under applied overhead. Under applied overhead means that the actual costs were more than what we applied. Over applied means the actual costs were less than what we applied. Okay? So if we under apply it, we're going to have to add that amount we under applied. If we over applied it, then we're going to subtract. Okay? Pear Company's actual overhead for the year was $650,000, with a total of 170,000 direct labor hours worked on jobs. Pear's predetermined overhead rate is $4 per direct labor hour. So 4 times 170,000 direct labor hours means we applied 680,000 to jobs. But guys, our cost was really only 650. You see that? You see we over applied to jobs? We said they cost more than they really did cost. Okay? Meaning Pear over applied overhead for the year by 30,000. What's Pear going to do? They're going to adjust the cost for those jobs is higher than they really should be. So what they'll do is subtract that 30,000. Won't they? Look at this one and tell me what you guys think. Try this one on your own. I didn't grade your chapter 1 Excel. I am so sorry. We'll get that graded right now. Y'all ready? So what happened here?
I thought me that 50,000 was under applied.
Okay. Anyone else? Good. Excellent, guys. It's making sense, right? Okay. So any remaining balance in the manufacturing overhead count, like what we did here, the 30,000 over applied, can either be closed to cost of goods sold, or it could be closed proportionately to that which is still in work in process and that what's gone into cost of goods sold. So that 30,000 that we over applied ultimately is flowing, in this case, into cost of goods sold. So we're going to subtract. We really had 30,000 less in cost than what we initially thought. Calculating the over allocation of under or over applied overhead between work in process, finished goods, and cost of goods sold just is a little trickier because we just have to prorate those three different accounts. If cost of goods sold is 68, excuse me. So the work in process ending balance is 68. Finished goods is at 204. And the cost of goods sold is 408. So all of them are 680,000. In that case, we'll do pro ratio of 68 divided by 680,000, 204 divided by 680, and come up with what percent of that 30,000 we apply to each of those places. Make sense? It's just a little more detailed. In that case, work in process will decrease 3,000, finished goods will decrease 9,000, and cost of goods sold will decrease 18,000. Okay? Make sense? In summary, there are two methods of disposing of under or over applied overhead. We can just take it right to cost of goods sold and zero it out. Or what we just did is we allocated it between those three accounts. Because those goods are either going to be in still work in process or finished goods, or we sold them. What effect will the over applied overhead ultimately have on net operating income? So if we over apply it, it means we showed more cost of goods sold than we really needed to. So wouldn't our net income be greater? See what I'm saying? Because all that ultimately goes into cost of goods sold. Our sales minus our cost of goods sold gives us our net income. If we showed the cost is greater than what in fact it is, our net income will increase. Okay, how are we doing for time? Osborne, I'd rather do some homework. Let's just go into some homework, okay, guys? Let's start with Rahil. And okay, the first assignment come on. What am I doing wrong? Frustrating. Why can't I do it? Go into chapter 3 homework. Okay. Now, selected T accounts of Moore Company. They show us the breakdown of the raw materials. You see the balance that began, what was added, the ending balance. Then manufacturing overhead, same thing. Work in process, we need to know the ending balance. And finished goods and cost of goods sold. Basically, they want to make sure we understand how this works. What was the cost of raw materials used in production during the year? So what we're going to do is we're going to start at the raw materials. Started at 15, we added 120. If we have an ending balance of 25, what would we have added to the work in process during the year, guys?
110,000.
110,000. Excellent. Indirect materials. How much of the materials in one above consisted of indirect materials? How are we going to know that? It said, let me just look, of this number up here, we gave them, we know the raw materials was 110, but what direct materials went into work in process? See here it says 90. So wouldn't 20 be the indirect? That makes sense, guys? How I'm coming up with that? Let's look at indirect labor costs. What were the direct labor costs that went into the jobs? 150, right? 150. So what would the indirect labor costs be? Do you see here how we credited 180? See that? If we know 150 went into the work in process, wouldn't our indirect labor cost be 30,000? That make sense?
Or would it be, is it based on what debit amount of factory wages payable, was it 185?
That means
Or-
they paid it. That
Oh,
185 means they paid the cash.
Yeah.
But what we know what was credited means it was given somewhere. So the 180 minus the 150, wouldn't our indirect labor cost be 30? Okay, so how do we figure out the cost of goods manufactured for the year? Let's look at the work in process account. We have all of these debits, and we only credit it once it's completed, right? Wouldn't we see that our 470 would be our cost of goods manufactured? What we've actually worked on this time and taken out of work in process and brought it to finished goods, right? You see how this 470 is credited from work in process? Wouldn't that 470 go right into finished goods here? See that, how they're giving you a question mark, but we know when we credit a work in process, it debits to finished goods. Got it? That makes sense? So we know our cost of goods manufactured has to be 470, right? What is our unadjusted cost of goods sold? So how do we figure that out? Let's go look at our finished goods. Our finished goods started with 40,000. Didn't we add to that 470, right? From work in process. So a total available for sale is our 510. What is our ending balance in finished goods? 60, right? Wouldn't the difference have been sold? Do you see how the goal is to learn the flow of where the products go? So the difference between the 40 plus the 470 is 510. What got transferred out, which means sold? 510 minus 60 is what? That is what had to have been sold. Now in here, we're not really focusing on any underapplied or overapplied here. We're just focusing on the numbers. Okay? If overhead is applied to production on the basis of direct labor cost, what predetermined overhead rate was in effect during the year? So if we take our estimated total manufacturing times our estimated hours, let me see. What is the factory labor cost for the year? No, we got those. Number 6. If overhead is applied to production on the basis of direct labor cost. So our direct labor cost was how much, guys? 150,000, right? What predetermined overhead rate was in effect during the year? So the predetermined overhead rate is going to be the estimated total of the allocation base of 240,000. Trying to figure out where I'm, overhead here of 240,000. Divide that by our 150 direct labor. The 240 divided by 150 would be 160% of direct labor cost gets applied. I'll let you figure out 7 and 8 there on your own, okay? Next. Sorry, I don't know why my computer's acting up.
Sorry.
It's all right. Okay. Let's see what I'm doing wrong. Oops, you have this assignment open. I do have this assignment open. Come on. Okay, there it took finally. Sorry, guys. So here, Luzzati's company makes furniture using the latest automated technology. The company uses a job order costing system and applies manufacturing overhead costs to products on the basis of machine hours. The predetermined overhead rate was based on a cost formula that estimates 900,000 of total manufacturing overhead for an estimated activity level of 750,000. So from those, we can figure out our predetermined overhead rate. During the year, a large quantity of furniture on the market resulted in cutting back production and a buildup of furniture in the company's warehouse. The company's cost records revealed the following actual cost and operating data for the year. So we've got the machine hours, manufacturing overhead costs. We have inventories sitting at year end for the 3 raw materials, work in process, finished goods, and our cost of goods sold. Compute the underapplied or overapplied overhead. So how are we going to figure the underapplied or overapplied overhead? Well, we're going to take our manufacturing overhead, what we would estimate it to be would have been, let's see here. You know what I'm going to do? I'm just going to show you instead of, it's just too hard here. So I'm just going to show you. The way we figure out that it was underapplied is we will take the estimated total manufacturing overhead. We'll take our total estimated machine hours by that predetermined rate, and we can see what we so this is what we estimated, okay? We know we actually showed 850,000 of manufacturing overhead. See, we got that here. So technically, the amount that got applied to work in process for the year was our 60,000 actual machine hours times our $12 predetermined rate. So we underapplied 130,000, which means we showed our cost of goods sold to be much less than, in fact, what it really was. Got it? So this will be underapplied by 130,000. Next, what do we do about that underapplied? We've got to increase our cost of goods sold by 130. And we credit our manufacturing overhead to show that underapplied figure. Now in number 3, instead of just putting it all into cost of goods sold, they want us to divvy it up. They gave us our ending balances here. They gave us our ending raw materials, work in process, and finished goods, along with cost of goods sold. So in order to divvy it up, what we'll do here is figure out an allocation based on our work in process, our finished goods, our cost of goods sold, make a total, and then allocate it, prorate it. Okay, just like the example we did in the PowerPoint. Now we'll take that 130,000 times 5% work in process. This will be times 25% finished goods. And this amount, 70% goes to cost of goods sold. So we allocate it accordingly. Does that make sense, guys? Okay. Next problem. I'll let you do number 4 on your own. Next problem. Again, here we're going to prepare the cost of goods manufactured. Feel free to take a picture of this. Okay. So, you know, you're better off doing the work, but it's nice to have a check to make sure you're on the right track, okay? Here's the schedule of cost of goods sold. Here's cost of goods manufactured. Okay?
We're going back to the second one.
That one?
Okay.
Then, your last one. Oh boy, this is a big one. Okay, so I'm going to, because we're running out of time here, snap that. I need to scroll down. So have you gotten that? There's more. And guys, this is exactly what we've done in the exercises, okay? Now, here you have to post them to the various accounts. Okay? It was over applied. Here's how you're going to go about over applying it. And then ultimately your income statement. Now, guys, the one thing I didn't go over, but I might add a lecture later, is the Excel. Some of you are forgetting to look at the homework or what you're required to do. So with the Excel, they will give you, they usually have you work through creating some formulas, but don't forget the requirement. Check your worksheet by changing the total fixed manufacturing overhead cost for the milling department in the data area to 300,000, keeping all the other data as the original. If your worksheet is operating properly, the total cost of job 407 should now be 2350. If you do not get this answer, figure out what's wrong. What I want you to submit is this. Do you get what I'm saying? Some of you guys aren't submitting that. You're not getting to the required part. Go. Do you need to go, sweetie?
No.
Okay.
I was just saying, so it's the one that changed. Okay.
It's the one you change. So anyway, just know that, guys, that some of you guys aren't doing that and you're going to get the wrong answers. Okay? Any questions before we finish? Okay. I think we're good. I sure hope this Zoom happened. If not, that's a bummer. All of a sudden, I'm not seeing it. Well, guys, oh, there it goes. So take care.